Hello everyone, welcome to my channel. Today I'll just talk about derivatives that is very important for stock market. So basic of option that is a very important and key element key to financial success. So first is what is an option? The term option refer to a financial instrument that is based on the value of underlying securities such as stock, indexes, and exchange traded fund, that is ETFs, that is gold ETF, silver ETF, that is Nifty ETF, Bank Nifty ETF. So an option contract offers the buyer the opportunity to buy or sell depending on the type of contract they hold the underlying asset. Unlike futures, the holder is not required to buy or sell the asset if they decide against it. So each options contract will have a specific expiration date by which the holder must exercise their option. The stated price on an option is known as the strike price. On what price you are buying an option. An option are typically bought and sold through online or retail brokers. So every option has an expiration date. It's a monthly expiration date or it is a weekly. So like for Nifty, it is expiring on Thursday. For Bank Nifty, it is Wednesday. Fin Nifty, it is Tuesday. So what is the key takeaways? That is options are financial derivative that gives buyers the right but not the obligation to buy or sell an underlying asset at an agreed upon price and date. Call option and put option form the basis for a wide range of option strategies designed for hedging income or speculation. Option trading can be used for both hedging and speculation, with the strategies ranging from simple to complex. Although there are many opportunities to provide with options, investors carefully weigh and risk. Understanding options. Options are versatile financial product. These contracts involve a buyer and a seller, where the buyer pays a premium for the right granted by the contract. Call option allow the holder to buy the asset at a stated price within a specific time frame. For example, if I have to buy a Bank Nifty call option. So Bank Nifty, if I am buying a call option, I have to see it is a weekly expiry contract or it is a monthly expiry. On the basis of that, the strike price should be there. Like for example, if I am talking about today, if today Bank Nifty I want to buy for 48,200 call option. Call option means I am thinking that the market will go up. So I will buy the call option. So the strike price should be there. And if tomorrow is like Thursday, so tomorrow is a Nifty expiry, but Bank Nifty expiry is on next Wednesday. So next Wednesday date I have to buy or monthly ending date. So that is depend on the option. So call option allow the holder to buy the asset at a stated price within a specific time frame. Put option, on the other hand, allow the holder to sell the asset at a stated price within a specific time frame. Each call option has a bullish buyer and bearish seller, while put option have a bearish buyer and bullish seller. Trader and investors buy and sell option for several reasons. Option speculation allow a trader to hold a leveraged position in an asset at a lower cost than buying share of the asset. Investors use options to hedge or reduce the risk exposure for their portfolios. In some cases, the option holder can generate income when they buy a call option or become a option writer. Options are also one of the most direct way to invest in oil. For example, option trader and option daily trading volume, the open interest are two key number to watch in order to make the most well-informed investment decision. American options can be exercised any time before the expiration date of option, while European options can be only exercised on expiration date or the exercise date. Exercising means utilizing the right to buy or sell underlying asset or security. Types of options. Types of options means call option and put option. Call option gives the holder to right but not the obligation to buy the underlying security at a strike price on or before expiration. A will call option will therefore become more valuable as the underlying security rises in price. Call have a positive delta. Call have a positive delta. Long call can be used to speculate on the price of the underlying rising since has unlimited upside potential. But the maximum losses is premium paid for the option. Call option means if I am buying a option, so what is my thing? If call option means I feel that the market will go up, and for that only I am buying a call option. So that is the only thing. A long call can be used to speculate on the price of the underlying rising since has a unlimited upside potential. But the maximum loss is premium because chances if I for example if I buy a nifty call of nifty 21,600 call, if I bought it today and tomorrow is the expiry, that is tomorrow is 28th December, so nifty expiry, so that day if I'll buy today in 100 rupees, so my maximum loss what I paid a premium, that is 100 rupees, but my profit is unlimited because if market will cross 21,600 and if I bought in 100 rupees, maybe the price will be 50 rupees more or 30 rupees more. So that time my profit is unlimited, but my maximum loss is the premium what I paid for the option. Same thing for the put option. Opposite to the call. The put gives the holder right but not the obligation to instead sell the underlying stock at a strike price on or before expiration. A long put therefore is a short position in the underlying security. Since the put gain value of underlying price fall and it has a negative delta. Protective put can be purchased as a sort of insurance providing a price floor. For example, put option. I feel if market will come down and I bought a sell by I am selling the Nifty and if the 21,000 if I feel the market will come down to 21,500, so that time also my premium is the whatever I paid, that is my loss, and whatever if the price it will come down like 21,400, 300, whatever, that time it will be a profit, so unlimited fit. Now, American and European options. American options can be expressed any time between the date of purchase and the expiration date, but European options are different from American option. In this, they will only exercise at the end of the life or their expiration date. In between, you cannot sold. So the distinction between American and European option has nothing to do with geography, only with early exercises. Many options on stock indices are of the European type because the right to exercise early has some value, and American option typically carried a higher premium than otherwise identical European option. So this is because early exercise feature is desirable and command a premium. Option spread. Spread is nothing but it is a ask minus bid, whatever the selling price minus buying price. So spread option spread a strategy that use various combination of buying and selling different options for the desired risk and return portfolio. Spread are construct using the vanilla option, that is a little higher version, and can be take advantage of various scenario such as high or low volatility in the market environment or up or down moves in the market, because Michael Daw options theory is there. Michael Daw says market will move either uptrend, downtrend, or sideways. So that is depend on the news or any time in between. So that time spread strategy can be characterized by their payoff or visualization on of their profit loss profile. So such put call spread or iron condor. Buying call option. As mentioned, as mentioned, buying call option. As mentioned earlier, call option allow the holder to buy an underlying security at a stated strike price by the expiration date, that is called expiry. For example, I told if the Nifty expiry is Thursday, every Thursday is a Nifty expiry, and every Wednesday is a bank nifty expiry. And generally for the call and put it is a weekly expiry and monthly expiry. So Thursday, every week Thursday is the expiry. The holder has no obligation to buy the asset if they do not want to purchase the asset. The risk to the buyer is limited to the premium paid. That is again I'm repeating, the risk to the buyer if you're buying a call option, it is a limited because whatever the premium you are paying, but the fluctuation of underlying stock have no impact. Buyers are bullish on stock and believe the market price will go up, as I discussed earlier. and the strike price before the expire. If investors' bullish is realized and price increases above the strike price means whatever your buying price. So the investor can exercise the option, buy the stock at a strike price and immediately sell the stock at current price for the profit. For example, if I bought a SBI 550 call today, and that is a monthly expiry for the any kind of stock. So if SBI 560 call, if I 550 call, for example, SBI 550 call, if I bought it today, and the rate was 550 call is today is last is 2 3.6 paise, and the lot is of 1500. So 1500 into 3.6 paise I paid. But if tomorrow the price will be, if it will cross 550, and if I the price premium will go up, for example it will be 4 rupees, so 4 minus 3.6, 0.4 is my profit into 1500. So I paid the price that is 3.6 into 1500 per lot, but my profit, if the market current price is 4 rupees, so the difference between my current price minus strike price is my profit. So their profit on this trade is the market share price less the strike price plus the expenses of the option. So the premium and the brokerage commission to place the order. The result multiplied by the number of option contract or purchase. It multiplied by 100. Assuming each contract represents 100 share, for example here. So if the underlying stock price does not move above the strike price by the expiration date, the option expire worthlessly, and the holder is not required to buy the share but will lose the premium paid for the call. Meaning is that if you're not selling but you already bought it and the market not reached that, so whatever premium you paid, that is your loss. So your loss is maximum whatever premium you are paying. Same thing in the selling call option. Selling call option is called writing of contract. Selling call option, another name is writing. Call writer, put writer, we had name. So the writer receives the premium fee. In other words, a buyer pay the premium to the writer or seller of the option. The maximum profit is the premium received when selling the option. And the investor who sell an option is bearish and believe the underlying stock price will fall or remain relatively close to the option strike price during the life of the option. So if the prevailing market share price is at or below the strike price by expiry, the option expires worthlessly the call buyer. Same thing here, the examples are given. Buying put option. Put option are investment where the buyers believe that the market price will fall, I discussed previously, and below the strike price. So before the expiration date of the option. So once again, the holder can sell share without the obligation to sell at the stated strike price by the stated date. Since the buyer of put option want to stock price to decrease, the put option is profitable when the underlying stock prices is below the strike price. If the prevailing market is less than the strike price at expiry, the investor can exercise the put. They will sell their share at the option's higher strike price. So they will replace their holding of these shares and maybe buy them in the open market. Selling put option. Again, selling put option is called writing a contract. So buying call option, selling call option, buying put option, selling put option. So if you're buying, it is put normal call option, but if you are selling call option, that is a writing of the contract. Same thing for buying a sell option, and if you are selling call option, that time it is a writing of a contract. So put option writer believes that the stock price will stay the same or increase over the life of the option, making them bullish on their shares. So here the options buyer has a right to make the seller buyer's shares of underlying asset at the strike price on expiry. If the underlying stock price closes above the strike price by the expiration date, the put options expire worthlessly and the writer maximum profit is the premium what they paid. So the option isn't exercised because the option buyer would not sell the stock at a lower strike price when the market price is more. Same thing, if the stock price's value fall below the option strike price, the writer is obligated to buy shares of the underlying stock at a strike price. In other words, what? Put option will exercise by the option buyers who sell their share at a strike price as it the higher than the stock market price. So if the writer means if call writer, put writer, next video I will explain properly. Next, pro and cons. Call option buyer has a right to buy asset at a lower price than the market when the stock prices rises. But put option buyers profit by selling stock at a strike price when the market price is below the strike price. So option sellers receive a premium fee from the buyers for writing an option. What is the cons? The put option seller may have to buy the asset at higher price. See opposite that. Call option has the right to buy at lower price than the market price. But here it is a asset is higher strike price than would be normal pay if the market falls. So the call option writer faces infinite risk if the stock prices rise and forced to buy the share at higher price. Option buyers must pay an upfront premium to the writer of the option. Options terminology. Option trading involve a lot of lingos. They have just some key terminology to know the meaning of at the money. An option whose strike price is exactly that of where the underlying is trading, that is we can ATM option have a delta of 0.5. So at the price money call, we can say that if the market is now it is 21,620. So that point time, whatever is that, that is your at the money. Then in the money option, an option with intrinsic value and the delta is greater than 0.5. For a call, the strike price of ITM option will below the current price of the underlying for a put or above the. For example, I just told if the market is in 21,620. So ATM is 21,620 what I bought it. But if I below inside whatever if 21,600 if I am buying, the meaning is that it is in the money. ITM. Out of money if the market will be 21,620 but I am buying option for 21,700, that is out of money, means option will only extrinsic time value or and the delta will be less 0.5 for the call. So strike price of OTM option will above current price of the underlying. So that is in the money, at the money and out of money. So that is a below the current price. Premium, the price paid for an option in the market. That is your premium, how much you paid for that particular option. Strike price, the price at which you buy or sell underlying, also known as exercise price. And underlying means the security upon which the option is based. Implied volatility, IV. The volatility of underlying, how quickly and uh, fastly it's move and revealed by the market price. Exercise, when an option contract owner exercise the right buy or sell at the strike price. The seller is the said to be assigned. And expiration, the date at which the option contract expire or exit or OTM options expire worthless. How do option work? Option are a type of derivative. Call option, put option, these are the type of derivative. So options are the type of derivative product that allow investor to speculate or hedge against the volatility of an underlying stock. Options are divided into call option, which allow buyers to profit if the market price of stock increases, and the put option, in which the buyers profit if the price of the stock declines. Investors can also go short on option by selling them to the investors. Sorting or selling a call option would therefore mean profitably, and if the underlying stock decline while selling a put option would means profitability if the stock increases in value. What are the main advantages of option? Options can be very useful, the source of leverage and the risk hedging, how you are able to minimize your risk. For example, a bullish investor who wishes to invest $1,000 in a company would potentially earn far greater return by purchasing $1,000 worth of call option on the firm. As compared to buying $1,000 of the company's share, in this sense, the call option provide the investors with a way to leverage their position by increasing their buying power. Another hand, if the same investor already has exposure to that some company and want to reduce the exposure, they could hedge their risk by selling options against the company. So, what are the main disadvantages of the options? Main disadvantages of the option contract is they are complex and difficult to price. This is why the options are considered to be security most suitable for experienced professional investors. Or because in the recent year they have become incredibly popular among retail investors. They don't know much about the sales stock market, and they started uh, before investment they started the option trading. Because of the capacity for utilized return or losses, investors should make sure that fully understand the potential implications before entering into any option position. Failing to do so can lead they very much actually losses. So first you should understand about the derivative. What is derivative? It's a what kind of instrument? What is call option, put option, call writer, put writer, option writing, how it is happening? All that is a very important how, because it is a very much risky. So how do options differ from future? Both option and future are the type of derivative contract. They are based on some underlying asset or security. The main difference is that option contract grant the right but not the obligation to buy or sell the underlying in the future. Future contract have this obligation. Is an option, many times they will ask the question, is an option contract an asset? Yes. An option contract is a derivative security, which is a type of an asset. So the main thing actually ki how I am able to option means option is a type of derivative product that allow investor to speculate or hedge against the volatility of their underlying asset. So that is very important. So this is basic of options. So thank you for watching my channel.